The US commercial real estate sector is getting even worse, and many believe it is a ticking time bomb for widespread carnage across the banking sector as well. The Green Street Commercial Property Price Index is down, marking a sharp decline of close to 16% from the peak seen in May 2022. Now, this index tracks the pricing of institutional quality commercial real estate weighted across a number of different subsectors, including retail, office, apartment, and healthcare. The rapid fall we have seen this past year in commercial real estate now puts this index below where it was pre-pandemic at the end of 2019. And it gets worse in some regions and specific buildings, with Financial Times reporting that some flagship buildings in San Francisco and New York have traded down up to 75% and 30% respectively of their pre-pandemic levels. Just a couple of months ago, Starwood Capital Group defaulted on a $212.5 million mortgage on an Atlanta office tower, despite the investment group having over $115 billion in assets under management. Now, when asked about this default, a representative for Starwood Capital did decline to make comment. But they are not the only investment giant that has stopped making payments on commercial real estate loans and bonds. And back in March, Blackstone did default on a $562.5 million bond backed by a portfolio of office buildings and stores owned by a Finnish company. Now, Brookfield Asset Management Corp has also defaulted on a number of commercial real estate loans as well, including most recently in April a $161.4 million mortgage for a dozen office buildings, mostly located in Washington, D.C. And prior to that, in February, they also defaulted on mortgages worth over $750 million for 2 office buildings in LA. The delinquency rate for offices with commercial mortgage-backed securities has increased to 4.5% as of June, up from 1.7% a year prior, according to the financing data firm TREP. However, in some mid-sized cities, the delinquency rate is far higher than this, including in Charlotte, where it has reached a whopping 30%. Now, the rising vacancy rate across many US office buildings is leading to their value to plummet, which is why we are seeing a lot more defaults taking place. And when some of the largest institutional real estate investors like Starwood, Blackstone and Brookfield are defaulting on their commercial real estate loans despite having billions of dollars under management, then you know that there is big trouble brewing in the sector and potentially even more pain ahead. So why exactly is commercial real estate, especially office real estate, in so much trouble? So during the pandemic, many offices were emptied out as people could no longer come into the office to do their job and were forced to work from home. Now, companies around the world had to adapt to this new reality fairly quickly, and as such realised that having employees doing their job from home wasn't such a bad thing for productivity. And this gives companies the opportunity to downsize their office space or even make the permanent switch to remote work altogether. Now, owners of this commercial real estate are now earning far less compared to pre-2020, which is massively devaluing what these buildings are worth, and in many cases putting the owners into negative equity. And when these loans come to the end of a period and it's time for refinancing, the cost of the loan becomes a whole lot more expensive due to the surge in interest rates over the last year or so. New loan mortgage rates are far higher than when the loan was previously taken out, and so many institutional investors who own these office buildings just don't deem it to be worthwhile to continue their payments or simply cannot afford it anymore, leading to a default on the loan. Steve Eisman, one of the Big Short investors who predicted the 2008 housing crisis alongside Michael Burry, is very bearish on the commercial real estate sector. He recently said that there is about $175 billion of office debt due for refinancing this year and a further $150 billion in 2024, all of which will need to be refinanced at much lower property valuations and at a much higher interest rate. He also said that a loan taken out 3 or 4 years ago at a loan-to-value ratio was 60%, however today it is probably going to be around 100%. Banks often won't give out loans for 100% of property value and require some sort of equity down payment, meaning that the owners of many commercial buildings are faced with having to fork out even more cash to get their LTV ratios back in line with where they need to be. And according to this data from MSCI, there is $1.4 trillion of total commercial real estate debt maturing through to 2025, with the peak year being $485 billion next year in 2024. And as you can see from this breakdown of who this debt lies with, regional and local banks have loaned out a significant portion of this debt, as well as national and international banks too. Now, this could be a big problem for the entire US economy for a number of different reasons, particularly if we do indeed continue to see more and more defaults on commercial real estate loans happening. Now, the banking sector, particularly the regional and local banking sector, has been rocked in 2023, and we've seen a number of banks, including the likes of Silicon Valley Bank, collapse due to declining values of their assets, i.e. loans that they own. This situation could be about to play out again in the form of commercial real estate loans, as very soon banks are going to have to start writing down the asset values of the properties on their books that they have lent out money for. This will force the banks to recognise these losses on their income statements and balance sheet, and depending on how large the losses are, it could cause investors and customers alike to panic. And if these investors and customers do notice large losses in the bank and run to pull their money out, then this is exactly the sort of situation that can cause bank runs to take place. So all in all, things are looking quite grim for the banks. They are losing money to borrowers defaulting on their loans, which is inflicting heavy losses on their balance sheet. The risk of a bank run is therefore rising, all while interest rates continue to go up. I therefore think that we really could be heading towards a banking catastrophe, which would also impact the ability for the bank to lend more money out, and that includes all types of borrowers like businesses looking to expand their business. And this could of course lead to a sharp drop in the amount of credit available to be loaned out across the economy to businesses and others who want to borrow money, impacting economic growth. So how exactly does this situation get any better for commercial real estate buildings, particularly office buildings? It is quite hard to see how it does, and if anything, things are going to get even worse. The amount of debt in the sector just continues to build up and up over time, and we're going to keep seeing more and more defaults taking place. Now, the long-term trend for office working is only going one way. Now, for sure, some workers may have returned to the office as their company has decided to go with a hybrid working approach. However, many believe that gone are the days where people are working a 9 to 5 in the office 5 days a week, and we're going to see the vast majority of major companies adopt a fully remote work or a hybrid work model, which requires a much smaller office space. Now, taking a look at this chart showing the office vacancy rate, we're now at around 19%, which is the highest levels that we've seen since 2005, which is very concerning. And according to McKinsey, $800 billion worth of office space across 9 cities could become obsolete by 2030. And this does include a 20% fall in demand for office space in San Francisco and a 16% fall in demand in New York. And of course, the collapse of the commercial real estate sector would likely cause contagion across other real estate sectors, including the residential real estate space, like standard single-family homes, and ultimately put downwards pressure on house prices in the future as well. And of course, the residential real estate market is already suffering from various other types of downwards pressure, all of which is threatening to crush house prices in the coming years. If you want to learn more about this, then check out my most recent video, which you can click on the screen right now. Aside from that, if you enjoyed the video, then please do leave a like, as that does help out a lot. Also be sure to subscribe for more videos like this in the future, and thanks a lot for watching.